Trading for a Living, Alexander Elder. Most trading education hands you a chart pattern and quietly promises that the rest will take care of itself. Alexander Elder wrote Trading for a Living to demolish that promise because he came to the markets as a practicing psychiatrist, and in struggling traders he recognized the same self-destructive patterns he had spent years treating in patients. Core thesis. Elder's foundational claim is that successful trading stands on 3 pillars, and he sums them up as mind, method, and money. Mind is the trader's psychology, the ability to follow rules under pressure and accept losses without spiraling. Method is the analytical framework, the way charts are read and trades are found. Money is the management of risk and position size that keeps a trader alive long enough for the other 2 to matter. Remove any one of the 3 and the whole structure collapses, no matter how strong the other 2 are. His sharpest observation is about why the industry ignores this. Charts and indicators sell because they are concrete and teachable. Psychology and money management are personal and uncomfortable, so they get skipped. And the trader who has mastered only the chart self-destructs in ways the chart could never predict. As Elder puts it, the goal of a successful trader is to make the best trades, and money is secondary. When Osiris Capital Trading Desk grades a finished trade, all 3 pillars are on the scorecard at once. The context and setup axes test the method, the management and exit axes test the mind, and the size of the risk taken tests the money. So a weakness in any single pillar shows up in the grade no matter how strong the others looked. The loser's game. Before he teaches anything, Elder makes the arithmetic of the game brutally clear. Every trade pays a toll. The commission you can see and the slippage you cannot, and a trader who wins exactly half the time with equal wins and losses is a steady loser once the tolls are counted. To make money net of costs, you need a genuine edge in accuracy or in reward against risk, and preferably both. The professional treats those frictions as the first line on every ticket. The amateur ignores them while dreaming about profits, then wonders why a strategy that looked fine on paper bleeds slowly in real life. It is an unglamorous truth, and it filters everything else in the book. An edge that cannot pay the toll is not an edge. The clinical view of self-destruction, the most original part of the book, comes straight from Elder's first profession. He noticed that chronically losing traders behave like his addicted patients. There is the denial, the magical thinking, the secrecy about the real state of the account, the blaming of brokers and news and bad luck, and the endless promises to change that dissolve at the next open position. His conclusion is uncomfortable and liberating in equal measure. The market does not punish anyone on purpose. Traders punish themselves. And until the pattern of self-punishment is admitted and addressed, no method will survive contact with it. The path he prescribes reads like a recovery program. Admit the losses come from your own behavior. Accept that willpower alone has already failed. Commit to a structured system that removes the moment-to-moment decisions where the sabotage lives, and follow it whether or not you feel like it that day. The market as a crowd. Elder then widens the lens from one trader to all of them. A market is a crowd, and price is a running snapshot of the crowd's mood. A trend is what a one-sided crowd looks like, confident on one side and demoralized on the other. A trading range is a divided crowd, 2 sides in balance, pushing price back and forth between the bounds. Reading a chart is therefore reading people. The gaps, the breakouts, the reversals are collective decisions made visible, and the trader's edge comes from reading that mood more dispassionately than the crowd can read itself. When everyone is euphoric at the highs, the professional is looking to sell. When the crowd is panicking at the lows, the professional is looking to buy. Not because they are smarter than any individual in the crowd, but because they are calmer than all of them together, and willing to feel uncomfortable while the crowd feels certain. The triple screen. Elder's most famous invention is the triple screen, a system built on one unbreakable rule. Never take a trade against the bigger time frame. The first screen looks at the longer chart and establishes the tide, the dominant trend that sets which direction is even allowed. The second screen drops down a time frame and looks for a wave against that tide, a pullback that has stretched far enough to offer value in the direction of the trend. The third screen drops down again and finds the trigger, the precise break that turns the idea into a position. The power of the system is in what it forbids. A pullback on a 5-minute chart can look like a gift, while the daily chart shows it is a tiny pause inside a large decline. The triple screen forces you to zoom out before you act, and that single habit deletes a whole family of losing trades that tempt every intraday trader, the counter-trend fights that feel clever and end badly. Osiris Desk runs the same discipline across its time frames. It reads the higher frames before it will back an intraday idea, and a signal that fights the larger structure gets weighed and graded exactly as Elder would demand, as a lower quality trade regardless of how pretty the small chart looks. Indicators describe, they do not predict. Elder spends long chapters on moving averages, oscillators, and his own inventions. But the deepest lesson is his framing. An indicator does not see the future. A rising average tells you recent prices are higher than earlier ones. And that is all it tells you. The skill is in combining a few complementary descriptions into a confident picture of the present, and then trading the probabilities of that present. His practical pairing uses a trend tool to define where you are allowed to trade and an oscillator to say when. The trend tool grants permission in one direction only, and the oscillator times the entry inside that permission, buying the dips of an uptrend rather than guessing at tops and bottoms. No single tool is sufficient because every one of them has a blind spot. Averages lag the fast moves. Oscillators cry wolf in strong trends. The professional acts when the tools agree and stands aside when they argue. The one genuinely predictive signal Elder teaches is divergence. When price grinds to a new high, but the oscillator makes a lower high, the force under the move is fading even while the move continues, and that quiet disagreement is one of the earliest honest warnings a chart ever gives. The rules that keep you alive. The money pillar gets the plainest rules in the book. Never risk more than a small fixed slice of your capital on any single trade, so that even a long streak of losses leaves the account intact. Elder's benchmark is 2%, and his point is not the exact number but the shape of the maths. Small risks survive bad runs. Large risks turn an ordinary losing streak into the end of a career. He pairs it with a circuit breaker. When a month goes badly enough, stop trading for the month, because the wounded trader who trades bigger to win it back is the one who converts a bad month into a destroyed account. Survival is the precondition for everything else. The trader who stays in the game gets to benefit from every future improvement in skill, and the trader who blows up does not. Osiris Desk enforces this same survival arithmetic as it coaches. A strict cap on the risk in any one trade and a hard daily loss line, checked in real time, so the account is protected from the very spiral Elder describes before it can gather speed. Exits, the neglected half. The book closes on the topic almost everyone skips. Traders spend nearly all their effort on entries, and entries are the forgiving half of the job. Exits are where the money is actually decided. A profit target belongs at a structural level, a prior high, a measured move, not at a round number that means nothing to the market. A stop belongs where the idea is proven wrong, beyond the swing that defined the trade, and it never moves further away. And a trade that does nothing for long enough has quietly answered the question too, because the reason you entered has failed to appear. The hardest exit of all is the winner. The urge to bank it early is almost physical, and Elder's answer is to trail the stop behind real structure and let the market, not the nerves, decide when the ride is over. Bottom line, trading for a living endures because it refuses to let you specialize in the fun part. Mind, method, and money, all three, built together, or the whole thing falls. It gave trading one of its great systems in the triple screen, one of its great warnings in the clinical view of self-sabotage, and one of its great survival rules in the fixed slice of risk. Read it early, and return to it whenever one pillar starts stealing all your attention. A whole career gets built on habits like these. compounding on days when nothing about them feels dramatic. Osiris Desk exists to make that kind of compounding deliberate, an advanced platform for trader development and disciplined trade management, and the flagship of Osiris Capital. That deliberate compounding does not stop at the page, because Osiris Desk carries the book's method into every session. It weighs mind, method, and money on every trade it grades, checks the tide before it backs the wave, and holds the risk lines that keep a trader in the game, until Elder's 3 pillars are simply how you trade.